Kathryn Rooney Vera, Baltic Head of Research and Strategy, joining us now. Kevin is questioning whether or not we get a deal before the election. If we don't get a deal before the election, does it matter to equity markets?
I don't think anyone's expecting a deal before the election, Guy, and that's a simple fact. It's only 20-some odd days away, and it's very, very unlikely. The question for me is not if it comes before the election, or it's when it happens and to what magnitude. And the reason I think the markets are moving higher this week, Guy, is because it seems with increasing possibility that there is this blue sweep, and that's only positive, I would say, for one reason alone. And that reason is fiscal stimulus, because that is going to be big and bad and mighty if we get this blue sweep. So that's what I think is driving the markets. What has taken us to these heights is both monetary and fiscal stimuli, and the lack thereof could take us lower, and the prospects for more will take us higher. And I think that really is what at the end of the day is moving the markets.
So, Kathryn, you indicate that the timing isn't as important as just the fact that we get a deal and then ultimately its size. But when does timing become important? If we get through this fourth quarter of this year, if it doesn't come until after Inauguration Day, whether or not we get a Biden or a second Trump presidency, doesn't that matter? Neel Kashkari, the president of the Fed over in Minneapolis, spoke on CBS earlier this weekend, basically begging for fiscal stimulus, saying the recovery is slowing. Just take a listen to what he had to say.
The data is very clear. The recovery, the strong recovery that we saw in June and July has really flattened out. The virus is climbing now again around the country, especially here in my region, in Minnesota, the Dakotas, Wisconsin. And so you're seeing consumers pull back and not want to go out, not want to take that risk again. And so, unfortunately, we still have a long way to go in this pandemic, and that means we need continued assistance.
So, Kathryn, I guess my question is, can assistance really wait another 3+ months?
Well, Kayla, I think that's the right question. And retail sales come out this Friday, and we're expecting that to be the 5th consecutive month of expansion, but at a decelerating rate. The question we have to ask ourselves is this recovery in consumption and U.S. economic activity driven by fundamentals and some phenomenal acceleration in job creation and companies reopening and hiring in great spurts? Or is it due to government transfer payments and government stimuli? And I think it's the latter. I mean, you see in the month of April, the Bureau of Economic Analysis said that 30% of personal incomes now are derived from government benefits. That's an eye-popping number, and I think we have to come to terms with the fact that general consensus, both on the right and on the left, is that the government is managing the economy, and it's incumbent upon them to continue to, see its expansion. So yes, I think that it does become an issue if over the course of 2021 we do not see, another fiscal stimulus come to fruition. I think it's definitely in the works, especially as I say we get, a Democratic sweep. I don't think it's a matter of if, Kayleigh. I think it's a matter of magnitude. If it's Republican, you get $1.5 trillion. If it's Democrat, you get $3.5 trillion and higher.
In terms of what outperforms on that stimulus, almost regardless of size, what do you think it is, Kathryn? Where do I need to be positioned right now if I'm going to take advantage? How much is already priced in?
That's great. Look, Kevin was right. I think there is a lot of bipartisan support in certain areas. Fundamental and first and foremost, Guy, is in infrastructure spending. It's been long in the wait. Everyone's been waiting for it and talking about it. But I do think industrials and materials are going to outperform. So regardless of who wins, I do think, and I'm telling our investors to be invested in those two sectors. Depending on the results, I think you're going to see some subsectors outperform and some underperform. We've seen this over the course of recent elections. It's not that the market takes a slide because Trump wins or Obama wins or Biden wins or whatever. It's certain sectors. So the sectors we should expect to outperform are those that stand to benefit from the Green New Deal or some form of green energy stimulus. So we like green energy. You got to start looking at investing there. Industrials, materials. What may not be priced in yet is the inordinate rise in taxes that are going to hit corporate balance sheets, such as big tech, big oil, private insurance companies, and big banks. I think that's perhaps not quite internalized yet.
So when would that happen, Kathryn? The market seems to have adjusted to the idea of a Biden presidency largely. So much of the focus was about how long it was going to take, who actually won, how long it would take to figure that out. But those bets are starting to unwind around volatility around the election. So at what point does the market then have to stop and think, oh, wait, we now actually might seriously need to contend with a Biden presidency?
Look, I think if Biden wins, we're actually going to, it's market neutral to higher because, as I said, we have to focus, Kaylee, on what has taken us to these heights. And it is de facto, in my view anyway, monetary and fiscal stimuli. We've had fiscal stimuli that's quadrupled the U.S. deficit. We have had monetary stimulus that has doubled the balance sheet and looks to be moving higher and expanding its balance sheet to different asset classes. So that I don't think is going to change, which is going to take the markets higher, probably regardless of who wins. Now, as I said, if we get a Democratic sweep, we're more likely than not going to see a very generous fiscal stimulus package, which is going to take markets higher. In 2021, if we see this rollover on the economic growth variables, regardless of both monetary and fiscal stimuli, I think that's when the market can potentially get spooked. But until then, what we're recommending is long positioning on down days, protected in a barbell strategy, Kaylee, with defensive sectors that that counterbalance the more aggressive risk on portfolio, which is tips, gold, puts, private equity, low correlated assets, and the realization of some earnings and some profits on those sectors that have heretofore outperformed.
All right, well, you mentioned earnings. We're going to go there next. Kathryn Rooney Vera of Baltic, please stay with us. We are going to take a look at U.S. earnings season. J.P. Morgan kicking us off tomorrow. This is Bloomberg.
Let's get back to Kathryn Rooney Vera of Baltic. She's still with us. Kathryn, I'm hearing some chatter that this earnings season could come in above consensus. What is your expectation?
Well, consensus is so bad that it more likely than not is going to surprise on the upside. Year over year, I think, as Abigail just mentioned, we were expecting perhaps 30 or 25% to the downside year on year. But now that expectation has been cut to about 20% year on year. Corporate guidance hasn't really been there. So that has led to analysts expecting absolutely the worst case scenario. And that's normal for markets, right? To bake in absolutely the worst when they're left to their own devices and left with no guidance. So more likely than not, I would say that corporate earnings have hit the bottom in 2Q. 3Q is going to be more likely not better than expected, and much better than those worst case dire scenarios that have been priced in.
So if they do beat to the upside, is that actually going to be a positive catalyst, Kathryn? Will they get rewarded for that?
I think a lot is already priced in. I mean, we are very close to again to near record highs, and that's with a 30% expectation previously. I mean, we were at record highs with 30% expected to the downside. So if we beat that at 20%, I don't see that as moving markets markedly higher. Kaylee, I think what's going to be more important going forward is that additional stimulus package, both for markets and for the continuation of this consumption story, which has been in very large part driven by stimulus, both from unemployment benefits to direct transfer payments. We can debate whether or not that is good and healthy for the economy, but it is what it is, and that would need to continue for this market to move higher. And I think that from a corporate earnings perspective, again, what we need to consider is that increase in the corporate tax rate, how quickly it happens, and how dramatically it has moved higher, because that at the end of the day will impact in a direct way the corporate's bottom line.
Kathryn, where's the wild card? Where are the surprises going to come from?
Well, I'm actually would be surprised if we do get a contested election at this point. I think probably better for the markets would be a decisive victory, either one way or the other. A contested election would be a very positive thing for for gold rather, but would be decidedly negative for risk assets. But that seems less and less to be the case. We could get a surprise. I mean, a surprise for the markets would be a Trump re-election. A surprise for the markets, I think, would be a debacle, because I think that's largely been looked through. And Kaylee said it earlier, and I think U.S. Treasury yields moving higher, I think, is indicative of the market's pricing in a Biden victory. So a surprise would come from anything but.
All right, well, you mentioned yields moving higher, so that does kind of, in a way, lead me to banks, Kathryn, which, of course, are kicking off reporting season tomorrow. Sure. How do you feel about financials right now?
Right now, I think it's a mixed bag. I've liked financials for some time, simply because they've really pulled up the rear in terms of the market's rally. They've been undervalued, underloved, and underpriced. So we've been recommending long position in banks, and it's done pretty well in recent weeks. What I think needs to be considered going forward is if we have a change of regime and we have a less positive regulatory framework for the banks, then that would be a countervailing wind. That said, Fed, if we do get a yield curve steepener, which seems to be what the markets are starting to price in with higher fiscal stimulus, higher inflation in the pipeline, then that would be net positive for banks. So in the net, the drivers being both the Fed and federal government stimulus, I am still positive banks. I think banks have room to run. I think that this week is going to be a positive one from the likes of JP Morgan and Wells Fargo.
Kathryn, what is the signal-to-noise ratio going to be like within this earnings season? In the previous earnings season, many companies simply withdrew guidance. They couldn't give investors any clue as to where the businesses were going. Is that going to be rectified this time round?
Unlikely, I think, Guy, and that's going to weigh on sentiment to some degree, given that corporate guidance, we shouldn't expect it to be that clear or that persuasive or even that concrete going into 2021, given the combination of uncertainties that are still inherent, namely, of course, the virus and the lack of a concrete vaccine and a produced and readily available vaccine. So that being said, I don't think we're going to have strong corporate guidance going forward, although it will be better than what we've seen, which was a complete vacuum of guidance in 2Q of 2020.
Kathryn, one sector that has seen significant resiliency in the face of the pandemic when it comes to earnings is technology, but you have to pay a very lofty premium for that. Is it worth it, or are they too expensive here?
Well, technology has been the most beautiful sector, I think, this year, not just because it's had the best returns, but because it's both cyclical and defensive de facto. I mean, this is a sector that has outperformed in down days and outperformed in up days. So that I don't think goes away in the very near term, meaning the next 3 to 6 months. Technology has certainly been the driver of all of our comfort over the past 6 months. And until we do get some vaccine or some predisposition to go out and consume of our own accord, I think tech and stay-at-home stocks are going to continue to benefit from that. I think that stalls going into the end of 2021 if, in fact, we do recover from this crisis of confidence and viral pandemic. But I do think that technology on drop-offs, and we've been recommending this, Kaylee, when we saw that drop in technology, is an opportunity to accumulate positions just because it is, we think, fundamentally based and continues to see that demand from the retail space, which has been really flowing into the markets aggressively of late.
All right, Kathryn Rooney Vera of Baltic, buying those tech dips. Thank you so much for joining us today. Stick with us. This is Bloomberg.